Welcome to RONAS Academy, where all complications in all business related courses are made comprehensible via online means, where we establish the concepts and the principles that will aid you in passing all exams with an ease. So subscribe and become part of the learning family. The main source of income to most developed countries as well as developing countries is tax. Tax forms a larger portion of income to government or to every country. Therefore, it is required of all companies, in fact, those registered under the tax authorities, to make provisions for tax in their books of account. That is why the International Accounting Standard Board has devised a standard to provide or prescribe a guidelines for entities when they are accounting for said tax. And then these guidelines, these provisions are enshrined in the Accounting Standard 12, that is IAS 12. So basically, in today's video, we are going to look at IAS 12, income tax or taxation. When we say tax or taxation, in a layman's definition, we are just looking at a compulsory amount levied on an individual or a group of people or a company. So compulsory amount levied on people, basically that is tax. Now, IAS 12 prescribes the accounting treatment for only income taxes. The reason is that the tax or the rules pertaining to tax is different in every jurisdiction. What I'm trying to say is that how a company will account for its total tax in Ghana, in USA, in UK are different because the tax laws in their jurisdictions are different. For instance, we have UK tax the same way we have Ghana tax, we have US tax, we have China tax, and there are rules pertaining to the accounting for tax differs from one jurisdiction to the other. Therefore, IAS 12 just prescribe the accounting treatment for only income tax. And this income tax is categorized under two main headings, that is current tax and deferred tax. Taxation is a whole course that is in most of the professional exams like Institute of Chartered Accountants Ghana exams and that of ACCA. It's a course on its own. So IAS 12 does not prescribe the treatment for all tax because we have capital tax, we have gift tax and other tax. Remember again that IAS 12 does not prescribe or outline how a current tax should be calculated. Just remember that. So we are still looking at the scope. So remember that IAS 12 does not give guidelines as to how we should calculate for tax. Now let's look at the two categories of tax the standard has prescribed. That is the current tax and then the deferred tax. So we are going to look at current tax first, and then you come to deferred tax. Under the deferred tax, we will look at what is accounting profit and what is taxable profit, and why are we saying deferred tax. One thing you are supposed to remember is that anytime an entity is accounting for tax, then that tax comprises of two things, and that two items that comprise of the tax an entity is accounting for is the summation of the current tax and then the deferred tax. So we are saying that the tax that an entity will less from its profit is basically our current tax plus or minus our deferred tax. It is plus or minus because sometimes you have deferred tax liability. If it is deferred tax liability, probably it's going to take the plus. And if it's deferred tax asset, that means we are going to less it from our current tax. So the summation of this is what entities always account for in their books. Now, what is current tax? Let's focus on current tax. Anytime we are saying current tax, we are saying that it is a tax that is payable or recoverable by an entity with respect to its taxable profit. Very, very important, profit or loss, because sometimes an entity may incur a loss. So when we say current tax, we are looking at the tax that is payable or recoverable. It's recoverable because sometimes the entity may incur loss. And if the entity may incur loss, then there is probability is not always certainty. There's probability that the entity may recover the tax on the loss or the loss that the entity has made. That is why it is payable or recoverable by an entity with respect to taxable profit or loss. If that's the case, what is the difference between taxable profit and then accounting profit? There are two different things. So taxable profit and then accounting profit. Now, when we say accounting profit, is basically the profit before deduction of tax. Anytime you are looking at accounting profit, is also known as what? Operation profit. Any profit before we deduct, tax is accounting profit or operational profit. Now, when we talk about taxable profit, they are the profit that tax authorities base their tax calculations. It is the profit that is adjusted to account for the tax by an entity. What it means is that there are sometimes that entities will adjust their profit by some items that is not allowed by the tax authorities. And there are sometimes too the entities may deduct or add some items that is contrary to what the tax authorities provide in that particular jurisdiction. If that's the case, then there is a need for the accounting profit to be adjusted, which will be in accordance with the tax rules and regulations set out by the tax authorities. So after adjusting these accounting profits with the tax rules, what is allowed by the tax authorities, then the end result is going to be the taxable profit. That is why we are saying that it is a profit that the tax authorities, or by equity, the tax authorities base their tax calculation. So after getting this profit, you just multiply it by your tax rate to get the profit for the period. That is all about the current tax, because we are saying that it is a tax payable or recoverable by an entity with respect to taxable profit or loss. So now we know what taxable profit is, and we know what an accounting profit is. As said earlier on, the accounting standard does not prescribe how to calculate for current tax. But one thing you are supposed to remember is that we are supposed to account for under provision or over provision of tax. What it means is that anytime an entity, make an estimate of tax, entities always make an estimate of tax, and that estimate will be paid in a later period. So until the entity has settled the tax, we will not know whether there is the estimate is under or over provision. What it means is that we may be dealing with 2016 and 2017, and then in 2016 you provided that the tax will be $150 maybe dollars, and then in 2017 you also estimated that your tax is going to be maybe $150. But in 2007, the actual tax that you paid was $140. You made this estimate in 2016 at the end period. Remember, we are still dealing with current tax. Here, we didn't have any, way of calculating for tax, but there may be the question that you have will probably be opening tax, closing tax, and then the amount that they paid. Then they ask you to figure out the amount that they are supposed to account for. So in this case, we are having here to be the tax estimate in 2016. Tax estimate, that means it's payable, if not paid. But in 2017, we've also made an estimate of $150, but within the year of 2017, we've paid $140 in respect of 2016 tax. What does it mean? We make provisions for this, but we pay this. So this is what? This is over provision of tax. Anytime there is over provision of tax, it is an income to the entity. What it means is that I'll find the difference of this, which is going to give me $10. Then I have to less it from this tax before I'll provide for it, because I have over, deduct or reduce my profit. This is an expense, $150, so it has reduced my profit. But I actually made payment of $140. Therefore, I have to adjust my profit back by what? The 10 that I have already reduced the profit. That is what we talk about under and over provision of tax. So that is about current tax. in current tax, we look at the over provision or under provision of current tax. If it is under provision, then probably it is going to increase our tax liability in the next period. But if it is over provision, it's going to reduce our tax provisions in the next period. For instance, if in the actual sense we paid 160, tax in 2017, then we have made under provision. We are supposed to pay this, but we have made provision for only this. So the 10 difference here will have to be what? Add up. Here we will not less it, but it will what? You add up to this estimate in 2017, so that it will add up to $160 tax estimate in 2017. There will be a tutorial where we will solve a full question to augment your understanding, so do not panic about that. So that is about current tax. Remember that there may be some cases where the entity may incur a loss. If it is allowed by the accounting rules and regulations in that jurisdiction, and it is probable for the entity to project the profit for the next period, then we can go in for what we call a tax asset or tax reclaim. Although we are making a loss, because you are making a loss, you are not going to pay a tax on the loss. Probably you are going to get what we call a tax reclaimable to you, but that is only when it is probable. You will not get in terms of value, but you are going to offset the next tax you are going to pay in the next period. That is about current tax. Remember that the standard does not prescribe the accounting calculation for tax, but sometimes you have to look at the over provision and under provision of current tax, and you will solve a full practical question on it, and then you see how it goes in the next video. Turning our attention to deferred tax. What is deferred tax? Remember that we said that the tax accounted for by entities in the books is the summation of two categories of tax, that is the deferred tax and then the current tax. Now, if you look at the current tax, now we want to look at deferred tax. Deferred tax is not a tax levied by a tax authority or a government, as we have in the current tax, where we can, charge tax rates on the taxable profit. We don't do that under deferred tax. Deferred tax is an accounting measure. It's an accounting measure, but not a tax levied by government. It represents a tax that is being paid or that is payable or recoverable in the future. Remember that this tax is paid in the future with respect to transactions that have already occurred. What this simply means is that we are going to pay tax in 2018 with respect to a transaction that we have incurred in 2016. That is about deferred tax. Remember that anytime we are dealing with account of an entity, we deal with accrual concept. We deal with the accrual concept, which is in line with the provisions in IAS 1 presentation. So if that's the case, we are saying that we should mark our revenues against our expenses. If we have incurred a transaction here and we are going to account for tax in the future period of 2018, then there is a need for an adjustment. The adjustment that we are going to make is basically referred to as the deferred tax. For us to have an internal consistency with the account that we provide, then there is a need for adjustment. So the adjustment that we are going to make to cater for the consistency of your financial statements, then we come to the deferred tax. So that's why we said it's an accounting measure, but not a tax levied by a government, and therefore it represents the tax payable in the next or recoverable or in the future period. But remember that in relation to transactions that have already occurred. We have looked at two basic types of profit: the accounting profit and then the taxable profit. Now, remember that there are some items that the tax authorities will allow in the accounting for profit in the books of an entity, and there are some items that the entity will not allow. So, for instance, for example, is depreciation. the rate, depreciation is an estimation. So the rate that the entity will use to account for depreciation may not be allowed. That same rate will not be allowed may not be allowed by the tax authorities. So you have accounted for your profit over here, but we need to adjust this profit because these profits here comprise of items that are not in line with the tax rules and tax regulations. So anytime we adjust these figures with the provisions of the tax rules and regulations, the value, the outcome that we get is the taxable profits. This adjustment that we are having here also gives rise to what we call the deferred tax, concept. Now, this deferred tax concept comes about as a result of temporary difference and permanent difference. But in our case, we are just going to focus on the temporary difference because they affect the deferred tax, computation and calculation. So we are just going to base our discussion on temporary difference. So we are basically basing our deferred tax calculation on the temporary difference. We are saying that the temporary difference is always the difference between your carrying amount and then your tax base. So we know the difference, anytime we are looking at temporary difference, we are saying that the difference between your carrying amount and your tax base will give you your temporary difference. The carried amount basically is your cost less your accumulated depreciation. What about your tax base? Remember that the tax base is also known as the value of tax, okay, or the value for tax purposes. That is the tax base. How do you arrive at the tax base? The tax base is taking the cost of the asset and then you will less the allowances provided by the tax authorities. So where the carried amount is the cost less your accumulated depreciation, this is going to be the cost less your tax allowances that is given to you by your tax authorities or tax companies or registered tax authorities. So earlier on, we know that the temporary difference is equal to the carried amount of an asset less the tax base of an asset. Remember that the temporary difference, the difference between the carried amount of an asset and then the tax base of that particular asset will give us our temporary difference. In the introduction of this particular tutorial, I made mention of when the tax presented in the books of the entity is comprising of two things. We have the current tax, then we have plus or minus deferred tax. And I say that it is plus or minus because when it is deferred tax liability, so you have deferred tax liability, we are going to add. And then if it is deferred tax asset, then we are going to less. How do we arrive at that deferred tax liability and then that deferred tax asset? Anytime you are finding your temporal difference, and then the carried amount of an asset is greater than the tax base, you are finding the temporal difference, and then the carried amount of the asset is greater than the tax base, is going to give us what we call taxable temporal difference. So the temporary difference that you get here is going to be the taxable temporary difference. And then when you charge your tax rate on it, you charge your tax rate on this one, you are going to get what we call deferred tax liability. So remember that anytime the carried amount is greater than the tax base, you are going to realize what we call the taxable temporary difference. You charge your tax rate on it and you are going to get your deferred tax liability. Then if that's the case, anytime our carried amount is lesser than our tax base, we are going to get what we call deductible temporary difference. And when you charge your tax rate on it, you are going to get what we call deferred tax asset. So that is the difference. How do we get your tax liability, deferred tax liability, and then the deferred tax asset? Is basically looking at the weight of the carried amount and the weight of the tax base. So if the carried amount of the asset is greater than the tax base, then we are going to get taxable temporary difference, and this will lead us to the deferred tax liability. But anytime you're accounting for it, and your carrying amount is lesser than the temporary difference. It's lesser than the tax base. Your carrying amount is lesser than the tax base. Then you are going to get what's called the deductible temporal difference, which will lead us to what? A deferred tax asset. So if it's a deferred tax asset and you are computing for the total tax, you are going to what? Less it. And if it's a liability, you add it to your current tax to get a tax to be accounted for the period. For example, when we have the cost of an asset, so the cost, let's say, is $10,000, and then we have used the asset for maybe 2 years, and we are depreciating it over maybe the useful life of the asset is 10 years for that matter, and we have used it for 2 years. That means that accumulated depreciation is basically accumulated depreciation is going to be $2,000. Assuming that the tax authorities are giving us capital allowance to the, instead of using your depreciation, estimate, the tax authorities are giving you tax allowance. Let's say they are giving us $3,000 tax allowance, and then they are informing you that the tax rate is 25%. Please always remember that the tax rate is the tax rate that has already been enacted, or the tax rate that is substantively enacted, the one that is already enacted or substantively enacted. Substantively because it has passed through some legal process. The tax rate that are rumors and so forth that has not been processed or has not been enacted, we cannot use them when it comes to computation of tax. The standard specifically establishes that. So in this case, what is going to be our carried amount? So our carried amount of the asset after 2 years is going to be the cost of the asset, $10,000, less accumulated depreciation of $2,000, and this is going to give us $8,000. Now, what is going to be our tax base over here? Our tax base is going to be the cost of the asset, which is the same $10,000, and then we less our tax allowance over here, and this is going to give us $3,000, and this is going to give us $7,000. Now, look at the carried amount of the asset. Look at the tax base of the asset. This is greater than this. Therefore, we are going to get what we call taxable temporal difference. And this will lead us to deferred tax liability. So in this case, what will be your deferred tax liability is going to be your 7,000 multiplied by the 25%. And this will give you your deferred tax liability. That is just about deferred tax computation. So you watch the video on the full question in the subsequent one. Establish understanding, try and watch the tutorial on the practical samples that have been solved under the IAS 12. Now you understand taxation, how to basically account for tax. Remember this, we are looking at IAS 12 is looking at income tax, that is the current tax and the deferred tax. So you remember that you are supposed to disclose key items, what comprises your tax in the books of the entity, the amount of deferred tax, and then the amount of what current tax. And then also you should, if the company is making loss, what are your projections into the future that you are going to offset that tax recoverable in the future periods what profit. And then you should also disclose the key things that will provide relevant information for end users to use for their decision making processes. So that is about IAS, briefly theory about IAS 12. Watch the video on the sample where we solve questions to establish your understanding. Thank you.